So welcome to the HKS Energy Policy Seminar. I'm Joe Aldy, and I'll serve as the host today. Thanks to everyone for their patience as we've waited for our lunch. Thanks to our friends and colleagues joining us online on Zoom. Thrilled to have you joining us in this hybrid format. We're really excited today to have with us our colleague, Professor Akash Deep, for his talk on disentangling climate impact from development impact to mobilize climate finance, implementing the green swap. Akash Deep is a senior lecturer in public policy at the Harvard Kennedy School. He serves as the faculty chair of the Infrastructure and a Market Economy Executive Program and faculty co-chair of the International Finance Corporation Executive Program. His expertise lies in infrastructure finance and valuation, public-private partnerships, financial risk management and derivatives, and the management and regulation of financial institutions, financial markets, and pension funds. Akash Deep holds a PhD in economics and a master's in operations research from Yale University and a bachelor's degree from the Indian Institute of Technology, Delhi. Akash, welcome to the Energy Policy Seminar.
Thank you very much, Joe, and good afternoon to all of you. I'm pleased that you are here. I'm told that there are 3 climate events going on at this time at the Kennedy School, so I'm glad that you chose this one. And I'm going to talk about sort of 3 related things in here, and that's why this kind of long, unwieldy title. The primary goal of today's presentation is mobilizing climate finance. Okay. That goal we are going to achieve using a framework that is about disentangling climate impact and development impact, right? And most specifically, we will propose an instrument that we have labeled the green swap. And particularly, we have been working on this project for some time now in a variety of different ways. And I would like to spend some time, I will introduce the green swap and the rationale behind that structure, but I would like to spend some time also exploring and seeking your ideas on the implementation of this, because we are during our research at the stage where we would eventually like to do a pilot project to make this happen, right? This is joint work with a number of people here. My colleague Henry Lee, who's also the director of the ENRP program, who's here, and various students, who are here as well: Ruben, Stephen, Joshua, and Linus Beer. So we have a lot of people to answer your questions. So, as I said, I'll talk about the very quickly give you the feel for the problem itself. That's not research, our original research, that's citing some data. I'll talk about the rationale for the disentangling that I'm talking about. Moving on to talking about the instrument and how it enables financing. And then on the implementation side, there are a variety of details about the contractual structure, additionality, the role of multilateral development banks. And we'll spend a few minutes talking about this. This is work in progress. So again, your feedback here would be most helpful. I think the plan is that, I'll speak for about 40 minutes or so. But if you have clarifying questions, feel free to raise them. But I'll take substantive questions for later. So just a quick feel for the decarbonization challenge. Essentially, emerging markets and developing economies are not decarbonizing at the pace that is needed under the net zero scenario. Under the stated policy scenario, this is the situation. That is what we need, and you can see this in a variety of ways. One way to do this is to look at the share of fossil fuel-based generation. So if you look at emerging markets and developing economies, about a little less than a quarter of all new pre-permit, permit, and under construction power generation facilities. So this is essentially looking at about the next 3 to 5 years or so, is going to be in the form of fossil fuels. If you look particularly at a subset of countries, China, India, and Indonesia, that number is reaching almost a third. And another way to get a feel of this is data on India, and it shows you the great region shows you the existing capacity, but in addition, what you see here is fossil fuel-based plants under construction or pre-construction compared to renewables. And what you'll see is there is significant capacity that is being established in the renewables area, but about half as much is also being established using fossil fuels. In the case of India, it's primarily in the form of coal. In the case of, say, Indonesia, it is in the form of both coal and gas. And the reason for that is growth, economic growth, right? So on this chart, you see growth in GDP per capita, and here you see growth in carbon dioxide per capita. And what you notice is the emerging markets and developing economies, excluding China, are growing fast, and the specific countries, other Asia Pacific is Indonesia, Vietnam, there's India, Eastern Europe, but they're growing with a significant carbon footprint to that growth, as opposed to advanced economies that are actually decarbonizing. So the motivation for this research was that, in fact, part of the decarbonizing impact of advanced economies is being offset by the greater extent of carbonization in emerging economies. And that's because they are growing faster and they face a higher cost of capital. So this is just indicative data for a solar PV project. And what you notice is that costs of capital in these emerging economies is significantly higher, more in the range of 10 to 12%, as opposed to 3 to 4% in the advanced economies. And a reminder that the nature of renewables with their high capex makes them that much more sensitive to the cost of energy. So a 1 percentage point change in the cost of energy has tripled the impact on the cost of electricity that comes through renewables than it does. The cost of capital has a big impact on the cost of energy produced, right? And this shows you the share of financing cost. By the time you are in the 10 to 12% range, 55 to 60% of the final cost of the electricity produced comes from financing, as opposed to fossil fuel-based generation. So that's just to sort of give you a sense of the problem that we are trying to address. And so very quickly, a feel for the rationale behind this, and I'll do this qualitatively. We have some research that goes into the economics in more detail, in more formality, but I think the idea is relatively straightforward. And it is based on the observation that development and climate have different impacts. The different impacts are in the form of the benefits. The benefits of development are much more localized. They are to do with standards of living and reducing poverty. The benefits of climate are actually global public goods. Particularly, most of the time when I'm talking about climate in today's presentation, I'm talking about mitigation problems, right? So the greenhouse gas emissions problem, and those are global public goods, not local pieces. The way we address those development options is using what we call the development optimal option. That development optimal option, if it is green, great, but as we have just seen for a lot of countries, that development optimal option is not green, given the investments in coal plants. And the reason for that is development resources are scarce, and therefore the right development option is the cheapest one, and climate goals may have higher incremental cost. And finally, the risks of development are quite different from the risks of climate. In part, the high cost of capital that we are seeing for the developing economies is because of the political risks, the regulatory risks, the economic volatility that is there, as opposed to the global risks of clean energy. And therefore, we make the observation that if the benefits, costs, and risks of climate are different from the benefits, costs, and risks of development, so must their financing, right? Development finance must come from development sources. They can be global, they can be aid-based, they can be based on local. Usually it's a combination of those. On the other hand, climate finance should come from global investors because the benefits are global, but also significantly because the cost of capital is lower. And it is this disentangling between climate finance and development finance is what we are seeking to implement using the green swap, right? This is the idea that is motivating this. There are, if you have time at the end, I can talk about some of the other implications of this disentangling approach, but for now, I'll focus on just the instrument that we are talking about, which is the green swap, right? I'm going to do the next portion of the presentation using an example. And the reason for, there are some numbers here that I would suggest that you follow, but there are also, if the numbers become harder to follow, look at the colors. We've tried to make it helpful. But the reason we are doing this is, as I said, we want to focus on implementation. And one of the things we are doing in this project is trying to create a financial tool to be able to do this calculation of the viability of the green swap in trying to mobilize the financing, right? And I'll show you an example from actual data. This is two ways to generate the same amount of power, either using geothermal or coal. We have set this in Indonesia. And what you notice is the capex, there's sort of a 2:1 relationship. The geothermal upfront capex is about twice as high as coal, and the operating cost is about half as much as. These are present values that we are looking at. And you can see that coal is the development optimal solution if we do not think about climate impacts. And same information presented in a table. What I've done here is measured the impact. We've just taken a broad impact. This is just based on willingness to pay, based upon tariffs. But actually, tariffs, not even willingness to pay. And so both of these have the same impact. They generate the same electricity, but the relevant costs are different, 542 versus 603 for geothermal. And as a result, the rates of return of these two options are different. The cost of capital, there's a slight difference between these two because geothermal has higher risk, and therefore, but they're both around the 10% piece. And you can see that the coal plant is viable. It provides a higher rate of return, whereas the geothermal plant is not. And that's the reason why emerging markets and developing economies choose the development optimal option, or the brown option, the coal option in this case, right? If we take into account the emissions that will be generated by both methods, and we take the present value of that at about $15 per ton cost of carbon, this is what the costs look like, right? The emissions from carbon are added as a cost on the carbon side, and now coal is the more expensive option relative to geothermal, right? That's the, but it's, we have to incorporate this piece, this emissions piece, and that is going to be the basis of trying to orchestrate the green swap. So now the benefits are not just the development benefits, but they are also the climate benefits. That 133 is just the difference between 147 minus 14, so it's the net carbon emissions. We add that on. If you now calculate the rate of return, that's a more attractive rate of return. However, the development of the coal option is still the more, shall we say, economically attractive option from the perspective of the emerging market there. So what we propose is disentangling the development and climate impacts. So what we have now is, this is the benchmark coal. Again, remember, that was the cost of the coal plant in present value terms. That's the benefit. Here is the additional benefit, the incremental benefit from the greening of the coal plant, which is not to say that I'm taking a coal plant and making it green, but I'm saying if I were to do a geothermal plant, right, that's the incremental benefit relative to coal that I will get. The incremental cost will be this, okay? And so we are separating these two out, but the goal is to be able to, that has a rate of return of 11.7%, just this investment, but the goal is to finance that in global markets where the cost of capital is much lower. That is the essence behind, so this, the greening component is financially viable in its own right, it's economically viable, and so is the benchmark coal. And I call that benchmark coal because, again, we are not going to develop a coal plant, but we are only going to ask development finance to pay the cost of the development optimal solution, which is the coal plant here. Okay? So let me move on and describe to you why we call this the green swap. You know, why this term. And I think in understanding this terminology lies a lot of the value of what the mechanism does, particularly when it comes to risks. So I'm going to show you, this is a standalone coal plant. These are the cash flows. There's CapEx, there's revenues, there are costs and taxes. But we've, over the 30-year life cycle of a coal plant, right? If you look at it just in terms of present values, what does a coal plant do? The development investor invests in present value terms 542, that's the number, and reaps the benefits of 620. At this cost of capital, this is all viable, and this is a viable coal plant. Right? Now, instead of building a coal plant, suppose the development investor transmitted that upfront amount in present value terms to a climate investor and received benefits of the same amount. So now it's just like a coal plant, but these benefits are going to the climate investor. And on the other hand, think about the geothermal plant. This is the same set of cash flows for the geothermal plant. We can take present values of that. And the geothermal plant has a cost of, that's the upfront cost in present value terms. And here are the benefits. Those benefits are a combination of the development benefits and the climate benefits. Right? This is what a geothermal plant, standalone geothermal plant would look like. Okay? So now we put together the two investors. And what do we have? We have the climate investor investing in the geothermal plant, but a significant chunk of that cost is provided by the development investor. In return, the climate investor gets all the benefits, but then transmits back the development benefits, keeping only the climate benefits for themselves. In finance terminology, we sometimes say that the climate investor has a long position in the geothermal plant and a short position. They own the geothermal plant and they owe a hypothetical brown plant to the development investor, right? And the net of those flows is what constitutes the green swap. Right? So these red arrows essentially net out the entire cost. So the result of this is that the result is this set of cash flows, the red cash flows. And notice now that the cost of equity for the global investor is lower. Right? So this value, actually, what was 133 in terms of climate benefits is actually even higher in value because the cost of capital has gone down. Right? And that's why that number, but this is that same 133 number in terms of climate. So what do we have here? The red arrows show you the incremental cost of the green plant, of the geothermal plant, and it shows you the incremental benefits from the greening of the plant. The rest of the cost is borne by the development investor in exchange for all of the development benefits that come from it, right? So here are the net cash flows. That's the difference in CapEx. Remember that the CapEx for the geothermal plant is higher, right? So that's the net CapEx. And this is the difference in terms of cash flows. There are abatement benefits, of course, but there's also, because the operating cost of a geothermal plant, like most renewables, is lower, there's some value that comes from that as well. I'll show you that in a moment. So what is the net result of this? Relative to the development optimal benchmark, right? The development investor, the CapEx has this cost, right? So think of this, that if you invest in this plant, you dig yourself a hole of $244 million. Right? However, that fetches you abatement benefits. It has some tax consequences, right? And it fetches you some O&M benefits because of the lower cost. These are all present values. Right? This is at $15 a ton of carbon. If you do this at $20, that's what the picture looks like. Right? What I want you to notice is, and again, and this is why I wanted you to see the real data and in terms of values, the emissions benefits pretty much at $20 fully offset the incremental capex that is required. Right? So the O&M savings in some ways becomes additional value that comes from it. If needed, that amount can go entirely to the development side as well, making the development investment that much more attractive. Right? And we'll see later that we have incorporated some costs and there are some costs that we have not incorporated, but there is value. We need to cross this zero benchmark, right? So there's still some value on the table. Again, that value is coming onto the table because of the lower financing cost. Right? I find it useful to think about, when you bring in the global investor, you bring in two kinds of benefits, right? One, they value the emissions. That's this piece, right? Through markets that they have access to and so on. But also that is what I would call the funding benefit. You are able to get value from investors who value these avoided emissions. They also bring a lower financing cost, which is what this represents. And that's the financing benefit. You have to be careful with that financing benefit in the sense that it's important to segregate risks in the right way to be able to get financing at the 7.5% cost of capital. If you are not able to do that, you will go back to the 12% cost of capital that we talked about. Right? So that is. So here, I just threw in a slide in here to show you a very similar plant like this was financed about 10 years ago in Indonesia. They wanted to do the geothermal plant. It's not exactly the same zero. This is the financial benchmark. But if they did the geothermal plant, they would be this deep in a hole. The way they climbed out of that was a variety of subsidies. Right? They lowered the cost of capital from return on equity of 14 rather than 20%. They raised tariffs. They got loans from the Clean Technology Fund and the IBRD loan. So, and that is what made the project viable. The two things to note about it is, one, first, we are trying to make the project viable not versus some financial benchmark, but against a development optimal benchmark. Right? And that's a big methodological shift in how you view what climate finance needs to do, right? And the second is that we are bridging that gap by bringing that value over from elsewhere rather than through a series of subsidies, right? Which is how this was done. So the net result is, I showed you the swap picture, but the net result is a green plant will be financed using both development resources and climate resources. And when it generates benefits, the benefits will be split, right? But notice that this is not a co-investment, because in co-investment, there are risks that will have to be borne. And we know that the global investor does not want to take on the development risks that are in there. So that's why the swap perspective is important. The other thing to keep in mind is that this coal plant, which is what we are trying to avoid building, is central to this discussion, because this is what determines the size of these brown arrows. Right? And we are making the development investor bear the entire cost of the development solution. Right? And we need to know that cost in a way that is credible, that is contractable. And so it's sort of there. Again, in finance, we sometimes call this the notional plant. It's not a real plant, but it is important to separate out the benefits. Let me move on. This is just a breakdown of the same into two pieces. And we can talk a bit about, let me show you one more perspective on this to understand how the financing works, right? And here I will look at rates of return compared to risk. Okay. So what I'm looking at here, this is kind of a standard model in finance called the capital asset pricing model. What you have is risk on the horizontal axis and expected return or cost of capital on the vertical axis. The two lines here represent the cost of capital in global markets and the cost of capital in local markets, in this case, Indonesia, right? And the zero for this, the zero risk starts at a higher level and then goes up as risk increases. So here is a geothermal plant. It has some risk, and it has this rate of return. And that geothermal plant, I'm telling you the same story now from the perspective of cost of capital, okay, instead of cash flows. And that geothermal plant is not viable because for its level of risk, it provides a rate of return which is lower than the minimum rate of return that that red line represents. Okay, and so what we are essentially doing is disentangling this plant into two pieces. The brown plant is viable. That's what it means to be developmentally viable. Why is it viable? Because its cost is lower. It gives you the same benefits. And there is the greening component, which is much less attractive. But this is the disentangling that we are doing. And then that green component, of course, is not viable. It is well below the red line. But with climate benefits, it is much more viable relative to the blue line. That blue line represents the cost of global capital. And that's the way in which the two plants, not the two plants, the same plant's cash flows are disentangled into its climate component and into its development component, and they are financed by different investors. Okay. So that's about the green swap. Let me say a few words about implementation. We probably won't get a chance to go into all of the details, but here is the type of structure that we are thinking of. We are thinking about a special purpose vehicle for a green plant, that's the geothermal plant, which has co-benefits, power generated and avoided carbon emissions. Okay. And these are off-taken by the climate investors in exchange for the greening capex, that extra capex that is needed, whereas the development investor provides the brown capex and the opex. Okay. And depending on the price of carbon, you may need some amount of some adjustments to the O&M side, but the main place of value is the green project. And the result of this is that the risks that are on this side of the transaction are quite different from the risks. So notice now, currency risk and political risk and power production risk, those are all not the concern of the development of the climate investor, right? The risk that they care about much more as carbon price, the green performance risk. There may be some construction risk because if you don't have the plant constructed, you don't have the avoided emissions. And we may need some amount of insurance that is here, but this amount of insurance will be much smaller. It's only on the incremental piece. And it is probably for a smaller period of time than the entire life cycle of the plant, right? So that's the kind of contractual structure. So one of the things that we are doing is trying to come up with a contractual structure that is able to do that separation. And again, the focus of that separation is primarily in terms of making sure that the risks can be disentangled in the same way, right? So in terms of the value of the avoided credits, right? That is another piece that we are trying to work on. These are the core carbon principles according to ICVCM for voluntary credit markets. The most important one for us is additionality. And why is additionality an issue? Additionality has been an issue in general for many renewable energy plants because of a variety of reasons, thinking about, the complexity of the markets, how the grid responds. This is just a list based on some research. What is the counterfactual and so on. And we think that by separating out that development piece, as long as that brown plant, that hypothetical brown plant, is credible, then most of these concerns, we no longer care about the price of energy and the regulations and the project viability. If the project was not viable, it would not have happened in the first place, right? And therefore, what we need for this to work is somebody who can vouch for the development optimal baseline. That development optimal baseline will become the reference for additionality, which is the most challenging piece of meeting these principles. Why MDBs? We believe, and again, this is our proposal at this point in time. I showed you earlier development and climate impacts, but the institution that sort of straddles the space in between are multilateral development banks, right? They are the ones whose mandate is development, has always been development, and they have this additional mandate of climate. And it is a challenging task for these institutions to think about how to balance, to trade off those two different mandates. And we feel like this framework is a way that they can utilize that the framework along with their expertise, their credibility in what is developmentally optimal in terms of thinking about what the baseline should be, possibly providing some degree of risk insurance on whatever sliver of that's required, but also standardization and coordination across markets. Right? So that's we believe that in some ways MDBs will have to play a significant role to make this market credible. It's also they are the ones who sort of bear the brunt of reconciling donor countries' objectives and development priorities, right? And right now, much of that has taken a relatively crude form of saying, there is going to be very little aid for climate unfriendly projects, and yet a lot of countries are going and building these projects. So the green swap contract, we believe that permanence, quantification, and governance, because we have a viable brown plant sitting in the background all the time, many of these principles are taken care of by that green swap contract itself. And some of these, they become less important in the context of a green swap type structure, but many of them are also covered by the engagement of MDB, such as the World Bank. Okay. Couple of words about this is again very much work in progress. Who will these investors be? And when we started this project, we were focusing primarily on voluntary carbon markets. And voluntary carbon markets, one of their biggest challenges has been additionality. And that market has kind of gone up and down depending upon different different events, some of which that don't have necessarily to do with the carbon markets. But we do believe that both portfolio demand and corporate net zero goals are going to play a role. More pension funds, for example, are coming into this market. And so overall, there is an increase in size. Whether the voluntary carbon market is going to grow quickly enough and to the size to meet the challenge that is here, we cannot say that. Right? We also believe that we can bring in financing from Article 6 type credits, and these can be global or they can be just bilateral credits. We are seeing those growing, and we think that the green swap can unlock demand on those. And finally, we also think that there is some progress in trying to think about essentially what can be called voluntary carbon markets at the periphery of compliance markets. Singapore is trying to work on some of these types of structures and so on. So a combination of these, at this point in our research, I don't think we have a very clear sense of where specifically this demand is going to come from, but it's probably going to come from all of those. But also this market is very much a function of the integrity of carbon, and there is generally a struggle to be able to do that at the scale and at the level that we would like to have. Just in terms of the need for scaling, if we are thinking, remember we started by talking about new energy in AMDs using fossil fuels of that size. If you look at a plant that's the size of our plant, that's the faceplate capacity of the plant, we are talking about 5,000 projects, right? Even if you take a EMD as a plant 3 times that size, you still have a very large number of projects to be able to look at. I should also say that we we've done most of this research thinking about how to avoid fossil fuel-based plants from getting built, right? There is, of course, a lot of capacity, and there is all these ideas about the green swap can also be applied to decommission existing plants. The additionality issue there becomes easier in some ways because we are actually stopping emissions rather than avoiding emissions that are not there. On the other hand, it creates some challenges in terms of what else does the country or what else does the company do to generate that power if it gets offset in some other places. But we think that a lot of people have thought about how to shut down coal plants. It's important to think about how not to build new ones as well, right? In some ways, that's more efficient. Not all the costs have been incorporated in here. A significant chunk of, we are talking about geothermal projects, so new grid connections are an important part of, how do you offtake that power from the place where it is? And broadly speaking, just looking at aggregate number, that cost is about 20% of the size of generation. Right? Again, this is based on Bloomberg NEF data for all emerging markets and developing economies. But we believe that there is value on the table that we can finance some of these pieces. If we were looking at solar or wind plants in here, and again, we are building that into our financial tool as well, we would also incorporate or need to incorporate storage solutions to be able to create equivalent plants between coal and renewable energy, because intermittency becomes a big issue. So to wrap up, what the green swap does is that it mobilizes climate finance from global sources, brings in global investors who have an appetite, who have a demand, but who also bring a lower cost of capital to these projects. It establishes the additionality of climate efforts in a clear manner. That has been a challenge in this space. We believe that it provides a more just funding mechanism, because what we are doing is we're saying, well, if we are financing global public goods, let's not saddle the entire cost of greening infrastructure onto the development investor, right? That should be shared. And it provides a more forward-looking rationale for mobilizing funding, right? That is shared because the benefits are shared between these countries, rather than some of this debate has been much more backward-looking, saying, how did we get here? Who caused the problem? And this is, sharing future benefits is in some ways a more healthy and useful conversation to have. The broader idea of disentangling can be used in various other areas, and we are working on some of those. One, from the development finance perspective, it now also tells us what should development finance focus on. And as a co-effort on this project, we've been talking with the United Nations on financing for development. The 10-year conversation on financing for development is happening again this year, 2025. And many development interventions have now gotten saddled with that additional cost of climate as well. And how to think about those two separately. And we've seen some traction in using this idea to think about development goals as distinct from climate goals. And the same idea can be taken towards institutions. Most DFIs and MDPs have essentially put a layer of climate onto their development piece, right? And again, you are looking at the same project, but you need to think about two different sets of priorities and then bring them together to the project. So I'm not saying that development institutions should not have a climate mandate, but they will need to think about those in distinct ways rather than just layering on the climate piece. We could also use this idea to think about how to leverage limited climate resources, such as the $300 billion new collective quantified goal. Because notice again, the climate finance piece is only that incremental piece. It's not the development piece, right? By some measures, again, by the UN, the gap in development finance is $4 trillion a year. right? The 300 billion, even if we get to that number, is less than a tenth. So it's important that we use it in a way that is scalable. And finally, to think about just these climate finance needs. Most climate finance gaps these days, if that's the right word, essentially look at the entire cost of the geothermal plant as something that's a climate finance gap. But this framework basically says, no, it's only the incremental cost. The rest is development finance, and just makes that goal that much more realistic. And that really is the green component of this. So that's where I will stop. We put out a paper a couple of months ago that talks about the green swap, and that is available at the Belfer Center site. The Belfer Center is the one that has supported this entire research effort, and so we are really grateful for that in terms of seminar as well. And yeah, I think I'll stop there.
Great.
So,
Thank you, Akash. I see hands already going up, but I'm going to ask the first question, and then we'll go to the audience. So you give this example of this development optimal option. Here you identified it as a coal plant. There's a lot of discussion in climate finance to think about how we can sort of scale up to sort of the economy level or the country level. So for example, think not about a single project, but how are you going to develop the entire power sector for a country? Some of that is in the context of Article 6 discussions. Some of it has been discussed about whether there could be a kind of energy transition accelerator that would operate at, say, the country level for the entire power sector. How could we take your framework? Because I think it's more than just saying it's not one coal-fired power plant, it's 100. It's probably a bit more complicated than that. But how would we think about taking this framework and applying it to think about a development strategy, say, for the entire power sector for a developing country?
Yeah, that's a good question. And essentially doing the same thing. And there are some things actually that become a little easier to this. One of the things that becomes easier is you now get a portfolio of projects, right? And so instead of this one plant, let's say we dealt with PLN of Indonesia, which is the state-owned power company, and we could look at a portfolio of projects that they do, and we could actually build in some degree of over-collateralization, if you will, on the carbon side. And that will reduce if you have a portfolio of projects in terms of risks. It also helps us provide a stronger incentive to that country, let's say it's Indonesia, to be able to create a verification framework that these are credible and viable, right? It may not be worth doing for one project, but it's much, and the carrot here is this: if you do this, you get access to capital at 7.5% rather than the 12%. So I think the incentives are aligned to be able to do that, and in fact scaled up if we talk about portfolios of projects.
Okay, great, thanks. I'm gonna go to the audience now. Yes.
Hi, thank you for this. I have a question about the discount rate, or how you incorporated the risk of the abatement benefits in the returns profile that you said. I mean, if it's such a potentially all or nothing source of cash flows, but the return is still relatively low for that level of risk, how did you factor that into what the returns would be for the climate finance portion of that? And by extension, have you looked at ways in which to mitigate or ensure the risk of the volatility of the carbon markets themselves in order to maintain a lower cost of capital or certain return for that component?
Right. No, we have, to answer the last question first, no, we have not done that, because we believe that the climate investor is the one, whether they are a portfolio investor or a corporate investor, are doing that for a variety of reasons that make sense to them. What we have focused on primarily is that we would like that climate investor to not be exposed to the development risks, right? And so that is the portion that we want to keep away from the development. Otherwise, the cost of capital source, right? In terms of the rate of return, there is actually we were surprised at how much value there was, both from the emissions benefits and the funding side. And that's why I showed you that green portion and the blue portion separately. Of course, it's very tempting to get more of the financing from a lower cost of capital piece. But even by itself, at a $20 price of carbon, at least for this example, we were able to get the entire incremental capex, which is quite substantial in present value terms for this project from the global investor, and still leave a fair amount of money on the table that we could use from other pieces. So just in terms of that calibration, now that may not be the case for every project in every country and every counterfactual, but that's what we found. Also notice that we were quite conservative in the risk of the price. If you notice in the segregation of the prices, we had the risk of the greening component, and we had a pretty high beta. We actually believe that beta is smaller than what we have assumed, but we just erred on the side of, because we had money, we let that much risk be there. But again, the risk comes primarily from the integrity of the carbon markets, right? That has been our focus rather than the future price of carbon. And
if you can take it to the back, please.
Thank you. I have a question. Professor, in those markets where the grid capacity is very limited and the regulatory stable is weak, how do you consider the green swap structure might interact with the transmission constraints and the renewable integration risks?
Right. Very good question. And yes, that's a problem about integrating renewables into existing grids, right? Whoever finances it, whichever way we get them, that cost will have to be taken care of. And that's why towards the end, just as a ballpark number, that number is around 20% in the aggregate level. It might vary. And there is a question to be answered, which is who is going to bear that extra cost, right? Will it be, this is again going back to your question, if you think about multiple projects, we can actually spread that cost. If there are 3 geothermal plants, that each can pay 7%, and there is that would be easier. It also creates the incentive for the local government to be able to do that, because making sure that the grid is able to handle that gives them access to capital, which comes from global markets at a lower cost. So, but it is a significant piece of the cost, absolutely.
Just a quick clarifying question. So this model will work to the extent that the social cost of carbon is adequately priced, and that those externalities are recognized and adjusted within the relevant investment price. Is that right?
Absolutely, absolutely. Climate benefits have to be valued. Now, they can be valued in voluntary markets. It will be entirely the price. If they are made a part of some kind of a compliance type regime, that is another way to get value on that, or through Article 6 credits. And but we again took a fairly conservative number on the carbon side, and it is also based upon the idea behind what kinds of investments investors want to make. We believe that some portion of the demand will come from investors who simply want to invest in the risk and return of carbon markets themselves. Right.
So, Akash, to be clear, you need a carbon price from the standpoint of the investor, not in the local economy where the investments occur.
That's right. That's right. And a lot of local economies, when I was at the UN, there was somebody from the equivalent of the EPA in Liberia. They still have an EPA, but their claim was, they were working on a port, and they said, we don't understand what, at this point for Liberia, those avoided emissions have no value, right? But then taking them to a place where they do have value is partly what the green swap does.
So 2 more in the back, and then we'll come back.
Thank you so much. So my question is about, so a lot of the development of a project depends, as I understand, like the decision of the benchmark, right? Like the benchmark, like the Brown project that we're talking about. But this would be quite idiosyncratic to a specific market, right? Like, for example, like I'm from Brazil, like it wouldn't make sense like to talk about a coal plant because like in Brazil, most of our energy is already renewable.
Absolutely.
But on the other hand, like it does make sense, you know, when I think about it globally, to have more manufacturing being done in Brazil in comparison to like, you know, like Indonesia or China. So like how that benchmark, well, because like precisely because our matrix is already cleaner, right?
Mm-hmm.
So like how do you how do you think the discussion will be around this benchmark? Will this be thought about globally or like individually for one specific country? And just as a follow-up question, sorry, which markets do you believe that are more prone to receive such solution?
Okay, both very good questions, and I'll so yes, the development optimal benchmark, and that is going to be different in each situation, right? And that's why we need somebody with strong development credentials to be able to say. So let me take a different example. A city is trying to develop a public transport system and decides that a bus fleet is what they need, right? Now, a brown bus fleet, a fossil fuel-based bus fleet, may be their development optimal transportation solution, right? And that will be the benchmark on which the cost of a green fleet, the incremental cost of a green fleet, is what the green swap would finance. Okay, and that's the way to think about. So, and the for that specific place, for that specific geography, for right, it's a, and so it is defining that additionality benchmark is critical, and it's significant work to establish that in a way that is credible, right? At the same time, it is the basis on which we do the contracting. So we don't have to think about all the, if the market for that changes, we don't have to worry about that because we are basically freezing that benchmark. We are agreeing upon it now, and then we are using that as the way to measure off the incremental pieces. But yes, we will have to do that work up front, right? In terms of sectors, I talked about energy in part because this is the energy policy seminar, and we have worked largely on this. But transportation is the other area where, again, the overlap between development and climate needs and the need for decarbonization are very similar. That having been said, transportation has slightly more challenging pieces. The Brown counterfactual here is the easiest probably to establish in energy markets. The Brown counterfactual in transport can be the fossil fuel-based bus, but it can also be modal shifts. It can also be city planning in a way that doesn't require the. So notice that it's becoming a little bit more complicated, and that's the area where we are going to be focusing some of this work later on. The area which is probably the farthest away from this, but an important part of climate finance, is adaptation. Right, and that is not amenable to this. So I want to be clear about where this can go and which are the places. And if you think about adaptation in some ways, what you are looking at is benefits that are much more local. Both the climate benefits in terms of resilience and adaptation are much more local rather than global. So we need to go back and think. So that's the more, if we survive in this research work, then one day we will address that and get to that.
Thank you. My question was about this domestic versus international pricing of carbon. Mm-hmm. From your example, I understand that Liberia today might not have much use for the carbon credits, but in the long run, because the carbon cost is not internalized domestically, doesn't this create a disincentive for pricing carbon in the domestic country?
Probably does, right? It's but then. And to be fair, it's not like these countries. So let's take another country like and India or Indonesia. It's not like they are completely unconcerned about carbon prices, but they have decided that their development priorities are more urgent than their climate priorities. So we will all get there, but at the same time, given that trade-off, the power plant that is being built today is going to live for 35 years, right? And so the goal is this to be able to address that and not wait for the time when the Indias and Indonesias, let alone the Liberias of the world, will be able to bring that at the same kind of level, right? And again, there's also the question about, but the first part of your question about the global benefits, these are global public goods. So it's also incorrect to saddle Liberians with the entire cost of financing these global benefits.
A quick comment, and then I'm going to go to Professor Hogan. In 1997, when I first started working on climate policy, I was in the government. We were working with the government of Brazil on an idea that evolved into the Clean Development Mechanism under the Kyoto Protocol. And one of the concerns voiced then was, if you're going to give developing countries the opportunity to do project-based emission reductions, that might discourage them from down the line taking on emission targets or implementing their own domestic cap and trade programs. Right? So there's this concern about, to your point, of this kind of incentive property. Having said that, the country that was by far the largest supplier of projects and credits in the Clean Development Mechanism was China, which now has one of the world's largest cap and trade programs. So there was also this kind of counter argument at the time. We're going to start to train people to understand what's the potential for pricing carbon to leverage investment. And what you might start to learn is that as you move from something that is project specific, that has higher transaction costs, than something that is creating a market that has this thing that actually functions more like a commodity, this allowance that gives you the right to emit, that you can buy and sell, that you'll see this opportunity to sort of scale up and ramp up to move from project-based to sort of a market-based approach. And that at least played out with China, and we're seeing sort of other economies that are sort of further along in their development path are more and more looking to cap and trade as a policy mechanism. Liberia is not at that stage yet, obviously, and there are many other developing countries who are not at that stage yet. But I think there is that potential to sort of develop some in-country expertise to understand what pricing carbon means for investment that eventually drives you to think through more comprehensive carbon pricing policies.
Absolutely. So.
I think I understood that. It was pretty interesting. I'm trying to catch up. This may be in the same spirit of the question about the riskiness of the cash flows on the other side, but I just listening to this, it sounds to me like it's inconsistent with the old-fashioned Modigliani-Miller theorem, which the basic insight was it's not the source of the financing, it's the risk of the cash flows that are coming in that matters, and all of this mixing between and the Modigliani, equity, debt, and equity is just an illusion, and you aren't actually getting anything. So that I don't understand why that's not a problem here.
Yeah, the good question, and the reason we have. So in the Modigliani-Miller type world, every financing is viable from any source at the right rate of return, right? We can always hike the rate of return as long as the project lends itself to that. What we have seen in practice is that global investors do not want to go to developing economies, particularly for infrastructure projects, because of a variety of risks. So even at a rate of return, even at that 12-15% cost of capital, only 15% of global flows for green finance go into emerging markets and developing economies, right? Whereas the need is greatest there. So what Modigliani-Miller assume is that there is no difference in, shall we say, taste or appetite across different types of investors, right? And what we are saying here, this is predicated on the fact is that there is a reluctance to go into emerging markets at any price because of the risks that are inherent in there. And providing a sufficient risk premium has not been sufficient to unlock those investments. And therefore, the idea is what we have done till now is trying to de-risk things. So, we have somebody come in like an MDB and say, we are going to de-risk the regulatory risk or the offtake risk and so on. And the challenge there is that we don't have enough resources to de-risk at the scale that is needed. Currency risk is another example. Right? And so what we are saying here is that don't try to de-risk, is just make that risk incident upon the investors who should take on that risk, right? If if it is the case that investing in a developing economy is viable, if creating a bus fleet in Brazil is risky, that bus fleet must meet the test of being viable at that level of risk, right? Lowering that risk and making it viable at a low cost of capital actually ends up building bus fleets that may not be viable on their own. And so that separation creates the viability test for the development optimal solution and then creates that increment. But the important thing is to keep the risks apart, right? And therefore address to that appetite. When we draw those two lines on the capitalized pricing model, that itself becomes a representation of the segmentation of global and local markets. And so we are taking the carbon out from the local economy and putting it in the global economy through those credits so that that hesitation is not there, but we are also removing all the risks from that carbon.
So I know there's a few more questions, but we need to wrap up. So let me encourage you, if you still have questions, to come up to Akash after the session. Before we wrap up, let me note that we will meet again a week from today in this room at noon. We'll be hosting Beth DeSomber of Wellesley College for her talk. Finally, please join me in thanking Akash Deep for his presentation and insights today. It was great, Akash. Thank you.
Thank you, everybody. Thank you. Yeah.